All right, ladies, in today's video, I'm gonna help you step into your rich girl era through investing. It's time. I spent most of my 20s broke, in debt, and just financially struggling overall, but I had a deep passion for figuring this money thing out, so much so that I studied finance. I got a job as a financial advisor. I worked at Morgan Stanley and E-Trade, and even through gaining all of this knowledge, I was still confused when I first started working one-on-one with clients. Investing is really confusing, and I think it holds a lot of people back from getting started, but it was absolutely game-changing, life-changing in helping me accumulate some money. Once I figured it out and stuck to it, as intimidating as investing may seem, it's really not that complicated. There's a few core things that you do need to know and understand, which we'll go over today, but beyond that, it does not have to be as complicated as the Wall Street people make it seem. After this video, you'll have a basic idea of how to actually invest to grow your money long-term so you can build significant wealth using the same tools that my wealthy clients did when I was working at these big brokerage firms. So when you first start investing, and this is a key thing that you need to understand so you're not discouraged, the majority of your account's growth is going to come from your own deposit. You're not gonna make a deposit and then see this huge growth from your investments. There's just not enough money yet to gain that traction that you need for exponential growth. So in the beginning, you kind of gotta use faith that it will work just based on historical figures and keep putting money into your account so that eventually there will be a shift where the growth will start coming more from the investments than it does from how much money you're putting into the account. Now let's get into a few different investment options that you have and the ones that I think that are the best to get started, especially as a beginner, but really for anyone. So just a basic overview of some of these investments. Mutual funds, index funds, stocks, and bonds are the primary types of investments, and all we're really gonna get into today because they're all you need to get started. When you buy a stock, you're buying a portion of a company. If that company performs well, then the stock goes up in value. If you sell it, that's when you make money. If the company does poorly and you sell it, that's when you lose money. And it can go up and down while you own it. What matters is when you sell it. If it's higher than when you bought it or if it's lower than when you bought it, that's when you know if you've made a profit or if you have a loss on that investment. A bond is a loan to a company. If Coca-Cola wants to raise additional capital, but they don't want to give out any more ownership, they might issue bonds, meaning that if you give them $1,000, they'll give you a few percent over a year, let's say. And then after that year is over, you get your $1,000 back, and you also get that few percentage points of interest over the year. Mutual funds are baskets of investments, stocks, bonds, or a combination of both that a money manager hand selects to put inside the basket. They have a fee for this service. They believe that this fund is going to do better than other investments. So when you buy the fund, you're buying this whole basket of investments that can be conservative, aggressive, or somewhere in between, depending on that concentration of stocks and bonds that they hold within the fund. More stocks means more aggressive, more bonds means more conservative. Index funds, on the other hand, don't have a money manager that picks what's inside. It's literally a mirror image of an index. For example, the S&P 500 is 500 of America's largest companies grouped together. An index fund is a mirror image of those 500 stocks. Buying an index fund is a really low cost, efficient way to invest because since there's no money managers, there's not that additional layer of fee that the money managers typically get. So you're able to buy this basket of investments at a low cost, and historically speaking, the index fund outperforms the majority of growth mutual funds. So it makes it just a better way to invest for growth and cost savings. So to buy your investments, you need an investment account. I typically recommend firms like Fidelity, SoFi, E-Trade. There's tons of really great firms out there, so don't get hung up on which firm to use. They're all really great. You can open different types of accounts. There's two primary ones, retirement and non-retirement accounts. These are called taxable or tax deferred accounts. Retirement accounts are things like your IRAs, your 401ks, and a brokerage account is your non-retirement account. So people often forget about this and they only think about investing for retirement, but you can actually invest for any reason, pre-retirement or beyond, inside a brokerage account. There's not tax incentives, but you have access to this money anytime. If you're just getting started and don't want to lock up your money till you're 60, then you could use a brokerage account. This is probably the best account just to start and learn. Once you've got your account open, you have a couple of options. You can use a digital advisor. A digital advisor is an option that takes you through a set of questions to get a sense of how conservative or how aggressive you want to be. And then they put together a portfolio for you that you just have to put money into. This is a great, super easy, really low cost way to start investing if you want to make it as simple as possible to get invested. And it's how I invested probably for the first 2 or 3 years of my investing journey. The downside is there is a fee that's a little bit higher than just going with index funds or stocks yourself. But until you have a larger portfolio, that fee is so nominal, it's really not worth stressing about. The other option is to pick your own investments. So for this, I like to keep it super easy and just pick 3 or 4 funds to go inside your account to offer yourself some diversification. So if you're an aggressive investor, and I would say anyone that's got more than 10 years until they actually need the money, you can be aggressive because you have both time and income on your side to recover from large market losses. But if you are aggressive, you can pick a large cap, a small cap, a mid cap, and an international. And if you want to be a little bit more conservative, you pick a few of those and add in a bond fund. With this option, every time you put money in, you are going to either have to split that up between the investments that you bought and rebuy those as often as you put money in, or you can set this up to happen automatically at a lot of firms. If you want to be even more aggressive, you might add in a few stocks. So my husband and I personally, we do 80% in index funds and then 20% in individual stocks. And that's how we keep it all split up and make it easy for us to invest consistently. Now, as you're getting started, I've heard so many people just have a ton of fear associated because you hear sayings like never invest anything you can't afford to lose. And I think the saying is just like, it messes people up because really, if you look at the numbers, the market bounces back. So if you can stay consistent and invest, especially when the market's dropping, you will be positioned so much better for exponential growth in the future if you can stick with it over time. You're very unlikely to lose money over a long period of time, like 7, 8, 9, 10 years. That chance of loss goes to practically none, but the opportunity for growth is massive. So to me, is just like a no-brainer. You put your money in so that it can grow. And you're really not going to lose it unless you're investing in super risky things like penny stocks, pot stocks, cryptocurrency, anything like that that's just like really unknown. So really avoid that stuff. Just keep it simple, keep it boring. Another way to lower some of those fears is to have an emergency fund and know that the money that you have in your emergency fund is what you'll use if you actually need it. So that way, if the market does drop temporarily, you just leave it, you keep investing, and if you need money, you pull from your emergency fund. When the market drops, this is actually a really good thing because you get to buy in at lower and lower prices if you're investing consistently. It's like buying things on sale. But I know it's really, really emotionally hard. If you can understand these emotions and just stick to a consistent schedule over time, you'll position yourself really well for growth. So let those things calm your fears, because if you just avoid investing altogether, you're missing out on a huge opportunity to grow your money. Compounding loses its value every single day because you're just not in the market. And the number one thing I heard from clients over time is that if they could change anything, is they would start investing sooner and they would invest more. So after you've got things set up, you've got your accounts opened, your investments purchased, stick to a schedule where you get money into the account regardless of what's happening in the market, and know that you're setting yourself up up for huge financial success in the future, especially if you can stick to it and add more to it as you're financially able to. This summer, I encourage you to get started with investing and really step into your rich girl era. Take a look at other videos in my channel to help you with more of the logistics on any of these questions that you have. Let me know in the comments other questions you do have. Thanks so much for watching, and I'll see you on the next one. Bye.